John Clifton, Jack Bogle, was an American philanthropist, business magnate, and most importantly, an incredible investor known for founding the Vanguard Group and creating the first index fund. In 2008, Bogle was awarded the Presidential Medal of Freedom, the highest civilian honor in the United States. In 2013, he was awarded the Congressional Gold Medal for significantly contributing to the development of structured finance and for his philanthropic endeavors. Bogle is the 25th richest American, with a net worth of approximately $9 billion as of 2018. Today, we're looking at 10 of the most famous investing tips from Jack Bogle. Beware of high fees. Fund fees can take a substantial toll on your investment returns. And over the long term, fees undoubtedly have an enormous impact on the size of your portfolio. Many investors, unfortunately, are blissfully unaware of the impact that fees can have on their portfolios. And many financial advisors, regrettably, are more than happy to keep it that way. The less you know about fees, the more money they make. Here, again, Jack Bogle sets the bar. He was one of the first investors to make a point of emphasizing the importance of fees, and of making sure that investors paid as low of a fee as possible. Avoid buying a fund just because it has a high rating. Just about every fund these days, indeed almost every investment of any kind, has at least one rating, usually from Morningstar, S&P, indices, Value Line, etc., touting its excellence, reliability, and so forth. The higher the rating, the better the fund, right? Wrong, says Jack Bogle. A fund with a rating that beats the competition on performance measures, but does so by investing in securities that are riskier and less liquid than its competitors, may deserve a high rating. But it may also deserve a low rating. Bottom line, study the rating itself and understand why the rating was given. If a rating is based solely on past performance, it's likely to be less meaningful than if the rating reflects a fund's expected performance going forward. Don't try to time the market. No one can consistently outsmart the market. No one, that is, except maybe Warren Buffett. So you're better off not trying to time the market, whatever your personal definition of time the market might be. If you think you can, you're almost certainly deluding yourself. What you can do, though, is to take advantage of the fact that the market is so efficient. Over the long run, it's next to impossible to consistently pick winning stocks and funds. But over the long term, it's also next to impossible to consistently pick losing stocks and funds. So if you invest in the entire market, that is, if you invest in an index fund, you're almost certain to end up with a portfolio that performs reasonably well, on average, over time. And that, after all, is the point of investing. Focus on what you're paying for, not what you're earning. This tip, which Bogle borrowed from his father, the late Vanguard founder John Bogle Sr., is related in a way to the previous one. If you focus too much on what you've paid when you bought a fund or a stock, you're apt to overlook how much you're likely to earn when you sell. If you paid $25 a share for a stock that went on to gain 50% in a year, great. But if you paid $25 a share for a stock that went on to lose 50% in a year, you're still $25 poorer. And of course, if you pay $25 for a stock that does nothing, you're $25 poorer too. The key then is to focus on what you're likely to earn, not how much you're likely to pay. If you pay $25 for, say, an S&P 500 index fund, you should expect to earn back the $25 and more over time. Rebalance. Rebalancing means periodically buying or selling assets in a portfolio to restore the original asset allocation. For example, suppose that you had a portfolio that consisted of 60% stocks and 40% bonds. If the market went up by 20%, your stocks would rise by 20%, and your bonds would rise by 10%. So 6 months after you rebalance your portfolio, your stocks would be 66% of your portfolio and your bonds would be 34%. Rebalancing your portfolio, that is selling some of your winners and buying more of your losers, can ensure that your portfolio winds up with its intended mix of stocks and bonds. Keep costs low. Keep costs low. Keep costs low. This is Bogle's mantra, and in fact, of all the investment tips on this list, this is probably the most important. Why? Because costs lower the odds that you'll earn a decent return. According to Ibbotson Associates, for example, the 20-year return on an S&P 500 index fund was 9.1%, including dividends. But if you added 2% yearly expenses to that equation, your return would drop to 5.5%. And if you added 3% yearly expenses to the equation, your return would drop to 4.3%. Don't try to pick stocks or funds. If you don't have the time or inclination to devote to carefully studying individual stocks and funds, you're probably better off buying a low-cost stock or bond index fund or exchange-traded fund, ETF. The investor who picks individual stocks or actively managed mutual funds should probably plan on lower returns. Why? Because most individual investors underperform the market. Indeed, some studies show that fewer than 2% of individual investors beat the market each year. By contrast, most index funds and ETFs are managed so efficiently that, as Bogle likes to say, a monkey with a dart could pick them. And of course, a monkey with a dart can't charge 2% per year in expenses. Don't try to beat the market. Here's another tip that Bogle borrowed from his dad, John Bogle Sr. The elder Bogle believed that trying to beat the market was a fool's game. And in fact, the evidence shows that the vast majority of actively managed mutual funds failed to beat the overall market. So rather than try to beat the market, you're better off trying to match the market. And once again, an index fund, typically an S&P 500 index fund, is probably the best way to go. An index fund basically buys the market. So if your index fund mirrors the S&P 500, you'll have most of the market's gains. But if your index fund mirrors the S&P 500, you'll also, broadly speaking, have most of the market's losses. Don't pay a lot for advice. Bogle was a fierce critic of financial advisors, financial planners, stockbrokers, and others who charge a fee for their services. He believes most investors would be better off if they invested on their own. Why? Because most investors would be better off if they didn't pay a lot for advice. Again, according to Ibbotson Associates, the 20-year return on an S&P 500 index fund was 9.1%, but the 20-year return on a fund of funds was 5.5%, more than a full percentage point lower. In addition, most investors would be better off if they invested on their own, because most investors are terrible investors, and most financial advisors are terrible advisors. The average financial advisor, yes, there are some good ones out there, tend to invest their clients' money in mutual funds with high fees, high turnover rates, and poor performance. Stay the course. This is Bogle's final investing tip, or at least it was Bogle's final investing tip. Bogle believes that most investors would be better off if they stayed the course. In other words, he believed that most investors would be better off if they held their stocks and funds for a long time. And if they held their stocks and funds for a long time, then they should invest primarily in index funds and in stocks that pay dividends. The combination of dividends and long-term investing produces significantly higher returns than the combination of growth stocks and short-term investing.